if you haven't already got an HP 12C, this is a really cool calculator. And I wish someone would have told me about this at a younger age. And it's a neat calculator because you can really organize your thoughts and the numbers in a systematic, simple way.
You know, of course, they have to have a $1 million gain to make it make sense. But you've also sat down, and this is a question I have, and you've calculated with them the return on equity of what they're currently doing. How do you calculate that, and why is that a significant part of your process?
Yeah, absolutely. It has to make sense financially, or it doesn't typically make any sense. And so, by the way, if you haven't already got an HP 12C, this is a really cool calculator. And I wish someone would have told me about this at a younger age. And it's a neat calculator because you can really organize your thoughts and the numbers in a systematic, simple way. Okay. So if you haven't already got one of these, I encourage you to get one of these. This is amazing. I think this is the best way to teach your kids, your grandkids, how to calculate numbers versus the standard calculator. Okay. So we always start with some of the basics, right? We want to start with how much is the property worth, right? In other words, are you sitting on land that you bought for $100,000 in Texas, and it's really worth $15 million because there's oil underneath it, right? And you're just sitting there, you're not doing anything with the oil, but someone will pay you $15 million so they can start pumping the oil out. So you're in it for $100,000, it's not producing any cash flow. And you're like, well, that's not great, right? We want to get that money and the equity working for us. And so the first thing we do is we figure out the price. So let's just use that scenario. Let's just say it's a $15 million property or business. And let's say it's land. And let's just say that land is really only producing, you might be leasing it out or to like a farmer or somebody who's doing something there, some crops or something. And let's just say they're paying you even $500,000 a year, right? Okay. You take that $500,000. Now, if that is your, after property taxes, after insurance, if you have insurance, all that stuff, let's just say you're netting $450,000, right? $450,000. So you're going to take basically your cash flow, income minus expenses. If you have debt service as well, in this scenario, we're free and clear, keep it simple. But basically, what are you making per year? In this scenario, it's $450,000. I'm going to take that $450,000. I'm going to divide it by the $15 million, what I could sell it for. Now, let's assume that's net of closing costs, because you do have to pay a broker perhaps, and you have some closing costs. But let's assume it's 15.5, you minus the closing costs. So I'm going to take that $450,000, divide it by the sales price minus the closing costs. In this scenario, we'll say it's $15 million. And that's going to give me a 3%, 0.03, 3% ROE, return on equity. Now you look at that and you go, well, that's not necessarily great. It's not, because you can go into money markets and make 4 to 5% right now, right? That's pretty staggering, right? You can go into the lending fund with the group we work with and make probably about 10%, which is pretty compelling, right? So that's the simple math. And so that's the first thing that we do.